Okay. So hello and welcome everyone. My name is Julia Plaxina. I'm from Refinitiv and I will help to coordinate HUPX Group and Refinitiv workshop on power today. Again, thank you very much for joining us today. Before we move to the main part of our session, there are a few housekeeping points I would like to cover. So at the bottom, apologies. So at the bottom of the webinar screen, you should see a toolbar. Please use the toolbar to access a range of applications, such as webinar materials, technical support, or completing a survey. Please click on the application and it should open on your screen. So all applications are resizable and movable, so please feel free to move them around to get the most of your screen space. Also, please submit your questions throughout the webinar, and we will try to answer your questions at the end of the webinar. For the best viewing experience, we highly recommend to close any other programs or browser sessions while running the webinar. The webcast is streamed throughout your computer, so for the best audio quality, please make sure your computer speaker's volume is turned up. A recording of the webinar will be sent within upcoming few days. And we really value feedback, so please do complete the pop-up survey at the end of the webinar. And if you are interested or if you would like to know more about how to manage power risk, and if you are interested in Refinitiv data, please also complete a purpose survey on the right side of your window. And also, dear audience, may I please also ask you to let us know if you can hear us by writing yes, we can hear you in a Q&A box. Thank you for joining us today, and over to Matthias Weito, CEO of HUPX. Thank you again for joining.
Thanks, Julia, and ladies and gentlemen, thank you for joining us this two-day-long workshop organized by Refinitiv and HUPX Group. HUPX Group is an integrated energy exchange, deals with power and gas, spot and derivative segment. The power is mainly driven by HUPX, and the gas is driven by CGEX, and the derivative part is run by HUDEX derivatives exchange. Today, we will focus on the power segment, and tomorrow we will have the gas session. Coming to our today's topic, it's probably a cliche, but it is true that we are living in a changing world. And to adjust this statement, this change is more and more rapid. What can be the reasons behind this? Let me give you some examples, basically two. Our generation is facing two big challenges: globalization and climate change. If we take the topic of globalization, I think it is nowadays really obvious that we are getting more and more interconnected. In the times of pandemic, COVID situation, we really face this. And it is a really big question how it will influence our daily life in the long run. And not only our private life, but also our work and our industry. And if we focus more and more on the power industry, we can also recall the climate change problem, which is the second big challenge I mentioned. And we have to find answers. The good news is that we are in the process. One of the biggest or the most effective tools to display this problem is the energy trilemma, which is probably well known for you, highlighting the security of supply, the affordability of the prices, and the climate targets. And the question is, in this model, where is the right balance? And for us here today, what might be the right market design to meet all the targets? I think about the what to do. Today's workshop will try to give you answers, or at least it will raise more and more questions. We will start from a holistic view with a keynote presentation, and then after we will go into the details with our panelists and with you, hopefully in the Q&A sessions. About the how, I think there is only one good answer, which is cooperation and fair partnership.
Right now,
and this is how
I think it's big.
We intend to work with you, with our partners, and this is how we would like to approach you and would like to behave. Thanks for joining us. Thanks for having you here today. I would like to ask you to ask questions and challenge us. And let's hope that next time we will be able to see you in person. Thanks a lot, and I wish you a good webinar.
Okay, good morning, everyone. My name is Christian Bay. I'm the Secretary General of HUPX, the Association of European Energy Exchanges. I've been asked to moderate the session yesterday evening due to some danger of availability. So this was on rather short notice. I would like to now introduce our first panel this morning, consisting of 4 speakers. Michaela Puccia from Refinitiv, and I'll come to their bios in a second. Laszlo Vara, the Chief Economist of the IEA, International Energy Agency, and Gabor Stapari from HUPX, the new Head of Sales, and myself, as I'd been initially scheduled for a panel slot rather than the moderation of the session. So what we'll discuss this morning is the role of exchanges in the future market design. We'll certainly discuss the big decarbonization challenge, how power trading will have to respond to all the different changes ahead. That's linked to decarbonization, it's linked to a change in power mix, and many other factors. And we will reflect upon how markets can contribute to deliver the energy transition at least cost. This is something easy said, but very difficult to do.
Can you see me?
Yes.
Okay. Okay, and can you hear me? Can anyone hear me?
Yes, Laszlo, we can now hear you. Okay. You were actually missing until now. Please feel free to start with your presentation, and then we'll move to the panel discussion afterwards.
Okay. And how do I move my? How can I get access to my slides? Or should I share my screen?
The organizers are putting it on now, and you can directly switch between the slides in the software.
Okay, I see it. I see it. Should I start?
Thank you for joining, and we'll be back in a minute.
Okay, thank you.
You can start, Laszlo.
Okay.
Thanks a lot.
Thank you very much, ladies and gentlemen. We managed to tackle the technical difficulties. It's amazing that after a year in lockdowns, we still have technical difficulties with the various video softwares, but hopefully this now will work. So at the International Energy Agency, every year we conduct an exercise which you call the stated policy scenario, but you could call it the don't shoot the messenger scenario, where we put up a mirror to the political decision makers that this is where your stated policies are getting the energy system. And under the stated policy scenario, we see a stagnation of global carbon dioxide emissions, no longer a rapid increase, but not a rapid decline either, which basically is equivalent to the world economy drifting towards a disruptive 3 degrees warming. We also did an exercise, the sustainable development scenario, which is, as the name suggests, is the mathematical representation of the Paris Agreement, where global carbon dioxide emissions decline by several billion tons already in the next decade, and then converge towards zero. How do we plug the gap? Now, first of all, several European countries did a pledge to cut emissions to zero by 2050. Unfortunately, the countries which made such pledges already were reducing their carbon dioxide emissions rapidly. And if you run the numbers, whether Denmark reduces carbon dioxide emissions by 85% or by 100% is not a big difference mathematically. Then last fall, a very important announcement was made by President Xi Jinping committing China to achieve net zero emissions. That's bigger than all the European announcements combined. But there's still a significant gap to be plugged. A large proportion of that will be the United States, where we expect, of course, the Biden administration to play a key role in the next climate summit. But of course, if you want to go for net zero emissions by 2050, which is a 1.5 degree climate goal, you have to reduce emissions even faster. And this very little black arrow, which you can hardly see, is the impact of the coronavirus epidemic on global carbon dioxide emissions. So in 2020, hundreds of thousands of people died, millions and millions of people lost their jobs, entire societies were locked down, and the impact on global carbon dioxide emissions was actually quite small in the context of the emission reductions and the energy transition that we will have to undertake. Now, the most important pillar of the energy transition, the two key technologies are wind power and solar power. For both technologies, the recent growth is just a taste of things to come. In fact, the recent investment will have to accelerate further. And if you run the numbers of how much new low-carbon electricity we will need, around 3 times every year, year after year, than what was the recent investment trend globally. And the large proportion of that is going to be wind and solar photovoltaics. Now, given the success of wind and solar power and the need for a rapid energy transition to zero emissions, that raises the question that is natural gas still a transition fuel? Is still a bridge fuel? Is still a useful fuel? In our view is yes, but certainly the prospect of natural gas is transformed by this, the need for a rapid energy transition. Under the stated policies, most of the gas demand growth comes from growing energy consumption in emerging economies. There is also a significant switching to natural gas, primarily from coal. Now, there is switching away from natural gas to renewables, and energy efficiency improvements also cut the growth for gas. But this is the stated policies. And in an energy transition case under the sustainable development scenario, we still have a bit of a switching from coal to gas in emerging Asia and a bit of a market growth. But half of the market growth will have to come from projects equipped with carbon capture and storage, much bigger switch to renewables, and a much more rapid energy efficiency improvements. So natural gas is still a useful fuel, but it has a much more subdued role. Now, given the fact that the overwhelming majority of new investment is wind and solar power, that necessitates electricity systems unlocking flexibility. New transmission interconnection is needed, which will link different power systems. For example, the newly established transmission line between Slovakia and Hungary is going to be very useful. Hungary has more solar production, Slovakia has more hydropower, so the production patterns complement each other. Electricity demand will have to be more flexible and more responsive to changes in the power system. Storage will need to be deployed, but we definitely think that dispatchable power generation, like gas turbines and hydropower power plants, will remain essential for decades to come. Now, one very important task, and I'm saying that as a former electricity regulator, is to modernize electricity regulation. And then I would quote the 20th century American writer Upton Sinclair, that it's difficult to get a man to understand something when his salary depends on his not understanding it. In many countries around the world, the current electricity regulation and current network tariffs create adverse incentives for new flexibility solutions. Very often, utilities don't have a financial incentive to help distributed resources. They don't have a financial incentive to appropriately remunerate storage. So the energy transition will have to involve not only technological innovation, but also innovation in business models and innovation in regulation. Now, all around the world, the most rapidly developing and most transformative new energy technology is solar. Now, of course, solar has very different prospects in, for example, India than in Europe. In both Europe, Japan, North America, there is a very large seasonal mismatch between solar production and electricity demand. Europe already has a winter peak demand in electricity. Now, electric cars consume more electricity during the winter than during the summer, and heat pump heating will further reinforce the winter peak electricity needs. This seasonal mismatch, several weeks or even several months, is not possible to manage with batteries. This is why we need the gas infrastructure and gas storage facilities. In the short term, with natural gas. In the longer term, with hydrogen. So the summer solar production would have to be turned to hydrogen, and the gas pipelines, gas storage facilities will be needed to store it. Now, both the costs declined for wind and solar power, and the ability of system operators to deal with the variability improved. But there are two major challenges still yet to be overcome. One is that both wind and solar is very visible and requires a lot of space. Social acceptance and permitting procedures is a major barrier. And for example, as you're very much aware, in Hungary, there has been no wind power developments for several years. It became just impossible to get a construction license for a new wind turbine. And the second is that these are electricity generating technologies, so we need to increase investment into the electricity network. In fact, in our sustainable development scenario, the global investment in the electricity networks doubles by 2030. The global electricity network investment historically peaked in 2016, and it has had a several years decline even before the coronavirus crisis. And if you ask the question that what is the biggest danger to the energy transition, where the transition can fail, in my view, that would be the failure of timely investment into the electricity network. Now, in the transportation sector, which today more than 90% relies on oil, the coronavirus crisis triggered a very important debate on how social habits and how social behavior will evolve. Because before the coronavirus epidemic, I would have flown personally to Budapest, and we would have had this conference in person, and I would have burned jet fuel flying to Budapest and then flying back to Paris. So we have seen the modern digital technologies having a significant impact on business travel. That's certainly true. Now, at the same time, we also see clear indications of people abandoning public transport as a reaction to the epidemic and preferring to use cars. So in the past couple of months, we have actually seen a remarkably robust rebound of global oil demand. Now, first of all, we hope that after the epidemic, public transport will be revitalized. Having said that, we don't see a realistic chance of people wanting to give up on cars. So the electrification of the vehicle fleet, bringing electricity to cars and replacing oil by electricity is extremely important. But this will be a major challenge for the electricity sector. It can be part of the solution, or it can be part of the problem, because the adding wind and solar to production will change the profile of the system. Now, if you also add uncoordinated charging, so as of today, the overwhelming majority of electric cars don't participate in any smart optimization, and the overwhelming majority of electric cars charge at home in the garage of the owner. So I get home 7 o'clock in the evening and I plug in the car. Now, if you do that, you create a very painful additional peak on top of on top of peak demand. And this doesn't matter with 1 million cars in Europe, but it will really matter with 100 million cars. And there is no chance to build a copper-plated electricity infrastructure which would be able to support uncoordinated stupid charging. So we need to make sure that we can turn the electric cars into flexible resources. The technology, the IT technology is ready, but there's still a lot of work to be done in coordinated data platforms, in making it smooth, making it consumer friendly. Now, another important impact of the epidemic is that there's 100,000 shops were closed down because of social distancing measures. E-business platforms like Amazon have been flourishing. Light trucks which deliver to shops and to consumers consume around 5 million barrels per day, which is like 5% of global oil demand. And we expect that the shift to e-commerce and shift to home delivery is to a large extent permanent. And these companies, including Amazon, are introducing services like same-day delivery, that's the Amazon Prime, which further increase the need for logistics because they have more frequent trips to consumers. Now, on the other hand, and I'm pleased to say that the International Energy Agency has been working with Amazon on this topic. These companies are financially very, very strong, and they can act as an early mover, fast adopters for new low-carbon logistical technologies, including electric and hydrogen fuel cell trucks. Now, of course, those delivery vehicles have very different operating patterns than personal cars. Most likely, they will charge at night close to the logistical centers. The electricity system will have to be prepared because, of course, the logistical centers have electricity, but they don't have enough network capacity to charge 100 trucks. So most likely network reinforcements will be needed. But in electricity systems like Hungary, where the low carbon generation is dominantly nuclear, the nighttime charging of those electric delivery vans is going to be very beneficial for the system. Now, there is also a discussion on heavy-duty trucks. It is possible to design an electric heavy-duty truck. It doesn't violate the laws of physics, but there are non-trivial difficulties, including the weight of the batteries. Also, privately owned cars, on average, park 20 hours a day, and on average, they need 1 hour charging. So once we digitize the system, once we sort out the institutional conditions for smart charging, there's a massive flexibility potential. But heavy-duty trucks don't park 20 hours a day. They participate in just-in-time operations. So when you run the numbers of how much energy the truck needs and how much time you have to fill it up, it will require a 1 megawatt size charger. And a 1 megawatt size charger is a very difficult, very disruptive part of the problem from the point of view of the electricity system. So we think that for heavy-duty trucks, other technologies like hydrogen will also play an important role to relieve the burden on the electricity system. Now, as I mentioned to you, in Hungary, very similar to other Central European countries, nuclear is the most important low-carbon energy source. And Central Eastern Europe is interesting in international comparisons that from Poland to Bulgaria, the Central Eastern European governments are unusually pro-nuclear compared to some other governments. And I believe this is the right decision. And I believe that even with the recent success of wind and solar technology, it is a good idea for Central Eastern Europe to remain nuclear. And the reason for this is land use and infrastructure. So 10 terawatt-hours of electricity, which is like a normal-sized nuclear reactor, or modern third-generation reactor, would be 16,000 football fields scattered all across the country, covered by solar panels, or 25,000 football fields full of wind turbines. So in Central Eastern Europe, there's high population density, high levels of industrialization. In that part of the world, we don't have places like Gansu and Xinjiang and Inner Mongolia provinces in China, windy, sunny places, very low population, huge amounts of land. You can put as much wind, as much solar as you want, or Arizona, Nevada, Wyoming in the United States. In the Central Eastern European context, it would be quite challenging to build a renewable fleet which can completely replace nuclear. It's not impossible. That's exactly what Germany wants to do, and there's no reason to doubt the sincerity of Germany's commitment, but it is not a trivial exercise. So if there is social and political acceptance for nuclear power, we believe that it is advisable to reinvest it and keep it. Now, given that the coronavirus triggered a major recession, and governments all around the world are implementing stimulus programs, that created a clear interest in linking the economic recovery with the energy transition. This is not a new idea. In fact, when you look at the history of the original Green Deal in the 1930s, the largest projects of the Green Deal, of the New Deal, sorry, that time it was called New Deal, not Green New Deal. It became green only later. But still, even though it was not called Green New Deal, the largest projects were energy projects, the big hydropower plants in the United States, in Switzerland, in France, because the energy sector has an ability to rapidly mobilize investment and stimulate other industries in the construction sector and also in the energy sector. So clean energy investment played a very important role in the recovery from the Great Depression, even though at that time there were no concerns about climate change. And clean energy investment can repeat this very important role today. So working together with the International Monetary Fund, we designed a sustainable recovery package, a sustainable recovery plan, which would boost the economy, create jobs, and improve the energy security and the resilience of the energy system. This is a three-year, globally $1,000 billion per year investment effort, which would focus on the electricity sector, energy efficiency, and other technologies like hydrogen and carbon capture and storage. A major advantage is the unusual macro-financial environment. Central banks, including the European Central Bank, reacted to the coronavirus crisis with an unprecedented monetary expansion. So interest rates are actually negative in the Eurozone and very low in the other parts of the world economy. And the experience suggests that some low-carbon technologies, like a big wind farm, a big solar power plant, if there is a credible regulation, if there is a clear long-term contract for the capacity, there is almost a substitute of a government bond from the point of view of the final investors. And there is a massive investor interest among institutional investors, insurance companies, pension funds, to put their capital into such contract-backed renewable assets. And consequently, low-carbon assets in the current macroeconomic situation can enjoy incredibly attractive, very low-cost capital financing. This is a window of opportunity which we can utilize. There's also very important for governments not to reinvent the wheel. After the 2008-2009 financial crisis, the European Union implemented green recovery measures, and there are important lessons from those efforts. One is that scaling up existing financing channels is more effective than trying to create some new institutional framework. It's worth focusing on modular technologies, solar panels, hydrogen electrolyzers, lithium-ion batteries, where one can trigger a very significant learning by doing effect by just adding more and more and more of similar modules. On the other hand, large, complex engineering projects have a tendency to disappoint, and they are not well suited for a rapid stimulus, because usually they are less shovel ready than they look, and very often there are difficult licensing and design and planning procedures to work on. It's very important to pay attention to the industrial value chain and skilled labor availability. Europe 10 years ago committed massive amounts of subsidies to solar, and then we ended up in a situation where 2/3 of the global solar panel manufacturing is in China. In the case of batteries, Europe now has a very important effort to make sure that there is a European value chain for batteries, and this can be done for hydrogen electrolyzers as well. And last but not least, the energy policy has important broader social implications on employment, on energy prices, on vulnerable social groups, and governments and policymakers have to pay attention to those broader social implications in order to make the transition politically viable. So this is how we see the transformation of the electricity system, and thank you very much for your attention. Thank you.
Okay, thank you, Laszlo. Now we're actually coming back to our initial agenda. There have indeed been some technical difficulties at the beginning. So the next part of this introductory session is a presentation by Refinitiv, in particular by Michaela Puica, which will last about 10 minutes. Then we will move on to our actual panel discussion with the aforementioned panelists. And then in the last half of this presentation, we'll first hear from the HUPX sales team about recent successes and achievements in the HUPX group. And then at the end, we'll go to a full Q&A with the audience. And I see some of you are already quite active asking questions. Some for the time being directed at Laszlo directly, so we'll take them up later during the panel discussion part. But for the actual kickoff, we'll now start with Michaela. So Michaela, please.
Thank you, Christian. Hello, this is Michaela from Refinitiv. I want to extend a warm welcome to everyone joining us today. And indeed, what I aim to bring with my short presentation today are some food for thought for our next panel discussion. And I want to start by a tale of two elements. I'm not going to look into demand for now, but I'm going to look into two elements that I think have shaped the way we see the energy patterns in Europe at the moment, how the supply stack has been evolving, and how the interconnectors have been changing the way we look at energy in Central Western Europe, but I will also go to Central Eastern Europe in a second. So the first element, the merit orders have begun to reshuffle. This has started happening already by 2018 or even earlier. And what I offer in this picture is basically a snapshot of how the merit order looks like for 1 hour in May this year. So you can see basically what is giving the price according to our model is a lignite plant. But if you see right after it and very, very flattened out is Datteln 4, which is the famous coal plant in Germany. And what sits behind that is a gas plant. So really there has been a reshuffling of the merit order. And of course, as the fuel prices evolve and other factors, this might still, this is an ongoing process. Of course, what shapes the prices, and I guess it's a hot topic nowadays for everyone in the energy industry, are the carbon allowance prices. Of course, there has been a rally lately. You can see on the left-hand side figure how the price has been evolving since 2018. But in addition to that, together with that, the short-run marginal costs of different fuels. So what you can see here in the picture basically is that the high efficiency, 56% efficiency gas plants are now basically right on top of the lignite in the merit order in general. So they're actually replacing the coal-fired generation. Of course, if we're discussing going forward coal phase out, and if we're discussing that right now the gas storages, at least in northwestern Europe, are 3/4 empty, then of course the keeping an eye on fuel prices is a must. But just as a main idea, what I'm trying to show here is the evolution of short-run marginal cost together with the carbon price, and how this has been shaping actually the prices, and are shaping the prices on a longer term. And of course, I mentioned the coal phase out in Germany. Everyone keeps the eyes on the coal phase out on Germany. The plan for now is to go to 30 gigawatt in 2022, so 15 hard coal and 15 lignite, 17 gigawatt by April 2030, and then 0 to 2038. Of course, some other European countries have announced their own schedule. France has the latest closure in 2022. Austria has already closed. The same with Sweden. And in the case of Germany, there are more tenders announced for more coal decommissioning in the coming years, with the dates mentioned in my slide. Okay, when we talk about what's going to come instead, we're talking about renewables. More offshore wind capacity is about to come in Germany. You can see actually in my right-hand side chart, we're talking about more than 13 gigawatts of offshore energy in Germany planned, and more than 2 gigawatts in Netherlands, for example, by the end of 2022. And the capacity in wind, at least according to the latest policies announced, are looking quite optimistic. Now, how many more renewables can the systems accommodate, or when are they in the money, so to speak? And I wanna draw your attention on capture prices. So capture prices is the average net price that a producer for wind or solar would get for 1 gigawatt. So we are 1 megawatt of energy. Sorry. So we are talking about price cannibalization, right? So you can see the evolution from since 2015. This is Germany wind, and this is so the charts on top are Germany wind and solar, and you can see basically a slight downwards evolution of the capture price, of course, as more and more capacity is installed. But the chart that you have right there at the bottom is the capture price for Spanish solar. Spain has been a country that has particularly installed a lot of solar energy lately, and you can see actually that the decay is much more important in capture prices. So the question that raises here is, how much more appetite will there be for installing more solar in Spain, for example? Now, the second element, more interconnectivity, and I have taken this figure from ENSOE. These are the current. This is the map, basically, as of 2019 of the interconnections between the countries in Europe. This interconnectivity topic, in particular, is going to continue shaping the prices for sure. And I want to show you just a small example on how the market coupling that was implemented back in May 2015 in Central Western Europe has started shaping prices. So the chart that you have on top is the amount of hours in percentage that the price is coupled with Germany. So what you can see, okay, in the very beginning, the 2011, 2012, the Dutch prices were very, very much coupling with the German ones. We believe in this point it was mainly because of gas reasons. Of course, gas back that time was not really that much in the money. But since 2015 going forward, you can see actually that the prices, the amount of coupling has actually started increasing. And you can see on my lower charts that actually prices are indeed starting to converge quite much better from 2018 going forward. So this is what is going on in Central Western Europe in terms of coupling. Of course, and when we're talking about interconnectors, we're looking also on what is scheduled, what is about to come. Of course, Germany, Poland, there's a 2 gigawatt both ways interconnector to come by 2023. There are several others scheduled here in my list. But what I want to raise maybe for our panel discussion is our forecast going forward up to 2030, which is a product that will soon launch in May. And what you can see basically in this figure is the fact that is the total net import for Germany, with, of course, from all the countries. And from 2022, we start seeing, according to our models, Germany being a net importer in total. Now, if we're talking, for example, Poland might actually start being a net exporter to Germany going forward, given the latest information and the latest plans, the latest information they provided on coal phase out. Now, in terms of price, our price outlook going forward to 2030 has a profile that you can see right here. I would directly to the red curve, the scenario average. Prices seem to basically start settling down by 2025 going forward. Right now, on a bit shorter term, for the May contract, we're bullish to neutral at the moment, according to our models. For the front quarter contract, we're bearish. We think the contract is a bit overpriced right now. And for Cal 22, we're also bearish. This is for the German part. Now let me just continue quickly this tale of two elements for Central Eastern Europe. What are our renewables assumptions, and how do we see interconnectors and prices going forward there? So I provide you here with a couple of snapshots on our assumptions on renewables, in particular wind. Wind is what you see right now on your screens. Poland, I would say, is scheduled to have the highest or the steepest increase in wind generation. We can say the same for Greece going forward. And in terms of solar, I would say, Hungary, much to expect around solar here, and Greece as well, of course, with the potential it has. Now, in terms of price convergence, we have done a bit of research when implementing our price forecast for Central Eastern Europe in ICON. We see price convergence, Hungary, Romania, for example, with Hungary being a net exporter to Romania. We see price convergence, and you can actually see it in my picture here. I'm not sure you're able to see very well the colors, but basically Bulgaria, Romania, which is the blue and the light green, also price convergence due to until 2020 July, due to the fact that Bulgaria was a net importer from Romania, but this trend looks like it has shifted since July last year. Then we see a Czech Republic, Slovakian price convergence, Czech Republic being net export, Poland to Czech Republic, not convergence, but we see Poland being having full imports from Czech Republic. So these are a bit the trends that we see at the moment on the market. And in terms of our price outlook, our price forecasting models for the front week for Hungary put us a bit on the bullish side. We see a front week contract of 62 euros. For Czech Republic, 63.2, and Poland 60.3. So a bit low, a bit more coupling with the German. In line with the German price. So this was my short introduction. Thank you, and let's just proceed with the panel discussion. Thank you.
Okay, thank you, Michaela, for this very insightful presentation. We already look forward to seeing Germany complain about Polish loop flows in the years to come. So there's indeed quite a lot of change ahead. We have already undergone a lot of change in the system, especially in the markets. Maybe to take a look back, so the energy market liberalization started in 1996 for electricity and in 98 for gas. So we're now about 25 years into the transition from a mostly state-owned, non-liberalized markets into a fully liberalized market. We're now seeing the fruits of this development, effect on merit order, real free price formation. And now we're looking at the second big transition, which is decarbonization. And just to refer to Matthias' introduction, the famous triangle, so decarbonization, affordability, and climate change. I guess we're now looking at deforming this triangle to the extent possible, and indeed at finding the right balance between the different elements. And where the market comes in is truly about affordability. How can we keep decarbonization affordable? There are major challenges ahead in terms of technology. That's what Laszlo already presented really well in his presentation. there are different ways of going about decarbonization. Some technological choices will have to be made. There's some natural developments happening as well. There's a lot of unknown, as referred to. And this keeps changing, and this will keep changing. And if we were to have the same discussion in 10 years from now, things will already look very differently. So just the debate about the EU ETS, for example, we're having today, look 3 years back when we had EUA prices at somewhere close to €3, unheard of. So I think the big lesson learned from all of this is there needs to be clear signals for the system to work properly. And there's one signal that can deliver a certain level of certainty, which is the price signal. And again, this is where the market kicks in. We now look at a much more decentralized system. We look at more actors. We look at new actors. We look at changing roles. The merit order is about to change, with the different elements coming in. The energy mix is about to change. And of course, the market's also changing. But the fundamentals, so the market price signal that is allowed to form freely following the liberalization, is certainly a very important element in the equation running up to 2050 and even beyond. The next big milestone, of course, will be 2030. There's a lot of regulation coming in. We'll see a Fit for 55 package proposed by the European Commission in June, with a lot of new updates of existing regulation. Some bits will be also completely new. So the regulatory framework is also trying to follow these developments and trying to shape them to the extent possible. The big fundamental issue, of course, is how can we ensure that we achieve full climate neutrality, net zero by 2050, while keeping this transition market-based, so affordable, delivering at least cost, while bringing all these new technologies on board. Some are already market-ready, others are absolutely not market-ready yet. There's a lot of research and development happening. That's something to be financed. Energy efficiency, of course, is another big elephant in the room. How can we improve it? Behavioral patterns are changing of final consumers, industrial consumers. We now look at a very different production model in various industries. Laszlo has referred to it very nicely due to the pandemic. There had been already very significant changes. There had been improvements in digitalization. Digital activities overall will also require much more energy in the future. So it's a very complex equation, which keeps changing. It's a moving target. We also have the global dimension, as was pointed out already several times before. The EU certainly is one of the leading actors, one of the most ambitious ones, climate neutrality by 2050, China following in 2060. The US is currently a question mark, also with changing administrations, may also be bouncing back at some point, should the government change again. So this is not a very straight path, but we have to deal with it. We have this ambition. We have a clearly defined target in Europe, at least, and we're now looking at achieving this at least cost and trying to get everyone on board, trying to use existing mechanisms, trying to build new systems and system of systems to make all this happen. So with this rather lengthy introduction, I would like to now introduce my fellow panelists. So we've already heard from two of them, but I would like to briefly introduce them a bit more in detail so that you, as the audience, have some more background about them. And we also haven't heard from one speaker yet, just for the completeness of this introduction. So ladies first, Michaela Puccia is a senior power analyst for Refinitiv. Already seen some of her work, but she's doing much more, of course. She's active in the power sector for some 6 years already. Before, she's been working on the US, Turkey, Brazil, Russia, and then at some point about European power markets as well. So she shares quite an international perspective with Laszlo. on market developments worldwide. And before joining Refinitiv, she's worked as researcher in geophysics on several international projects, again, around the globe, mostly in Europe. And I will leave it there. Then Laszlo Váró, who most of you already know quite well, and we keep seeing him on quite a few international panels. Laszlo is the chief economist at the International Energy Agency, based in Paris and also currently dialing in from Paris. He leads the Economics and Investment Office of the IEA, so the EIO, to stick with more acronyms. He's directly reporting to the executive director of the IAE, so Fatih Priol, who you all know. And he's worked with the IEA for some 10 years now, and became the chief economist of the organization in 2016, so 5 years ago. And prior to this, he served as the IAE head of gas, coal, and power markets. So he's quite a market expert, and that's why he's also on this panel today. And last but not least, a fresh face to the exchange world, but not to the industry, is Gabor Stapari, head of sales at HUPX Group since December 2020, so for some 5 months now. He initially started working in the energy sector with E.ON back in 2009, stayed with them for 5 years, then started working with Met Power Hungary as a senior portfolio manager, from where he then moved on to E2 Hungary, a joint venture of Met Holding and Telecom, and used to be the head of power procurement, and was, of course, in charge of hedging, pricing, portfolio management, and all the important skills you need to now head the sales department of HUPX. So with this rather detailed introduction, I would now suggest that we move on to an initial round of questions to all panelists, and would then have some more questions until 12. Which is in about 4 minutes, so we'll have to move on quickly. And then there will be still a presentation by Gabor about HUPX Group. So we'll try to keep it as short as possible, of course. The big question I really have to all of you, how do you see the role of energy markets by 2030? What will be the market design changes necessary to achieve 55% in 2030, of course, always looking at the EU only and not at the global dimension. And do you think that the current system is up for speed? So maybe Laszlo first, Michaela, and then Gabor last.
So I think that the electricity markets will have to play a critically important role. In fact, I think one underappreciated success in Europe is how well integrated and how smoothly functioning wholesale electricity markets are in the European context. And this is important because we have seen episodes like the problems with the nuclear power plants in Belgium, or an unusual sequence of weather events in Germany in November 2018, cutting wind and solar production. So we have seen episodes which would have been completely impossible to manage on a nation-state basis. And given that we need to further rapidly increase renewables, we have to take full advantage of the different geographical patterns across Europe. And also, the way to make demand flexible, usually the measures that we need for demand side flexibility are not technologically very difficult. I mean, your smartphone can run a smart energy system in your home, or your smartphone would be able to coordinate the charging of your car. What is much more challenging is to create a value, and for this, there needs to be an appropriate signal for the value. Now, I also think there is still work to be done. So one thing where Europe has been very, very reluctant is to reflect the value of location in electricity pricing. So North America is running locational marginal pricing systems. In Europe, even splitting Germany into two price zones is politically very controversial. I think we need to do a better job in reflecting the value of location in electricity. And also, by wholesale electricity prices will play an essential role in optimizing the system. I think for large capital-intensive investments, we will always need long-term contracts, capacity mechanisms, or other remuneration methods which enable project financing at reasonable conditions.
Okay, thank you, Laszlo, and also for keeping it short. I think I would fundamentally disagree on locational pricing and the nodal system, but maybe we can have this discussion at a later point. But given that I'm the moderator, I would like now to pass on the words to Michaela.
Thank you. I would answer your question from two perspectives, or basically with what we have and with what we would like to have, basically. How I see the market. So if we consider what we already have, what we know, what we see, then my view is what I have already showed in the presentation, basically, that the prices I see prices settling down from 2025 going forward. Until then, I see a bit of turmoil, and I see a huge need for more interconnectors. And yeah, I see basically, as mentioned, this controversial point on maybe countries who do not have a very clear timeline on decommissionings becoming net exporters. That is with what we have. What we would like to have maybe, then I would answer by comparing a bit with Australia. I'm thinking about batteries, more batteries. And also answering a bit on, I think there was also a question on from someone in our audience, EV, basically shaping demand. So I see demand being shaped, of course, from EV, but we have also seen demand being shaped by COVID effects. I put an example. We have seen Spain basically shifting a little bit its midday peak hour. Due to all this changing in behaviors and in patterns during COVID lockdown. So basically, let me just briefly present you. There was a small research done by a utility in Norway. As you probably know, Norway is quite the forefront of EV integration into the system. And as a utility company, they have done a small research, very numerical, on how they will see the patterns, basically the consumption pattern will evolve with more EV in the market. So they say that there will be a higher daily max than the non-EV owners. So in the households of EV, we will see a higher peak. The higher afternoon peak during the weekdays will be more pronounced for EV holders than non-EV holders. So basically, afternoon, and also the afternoon peak might shift a bit towards later hours in summer. So I think that we need to be, basically the transmission system operators will have to start coping with a very or much more dynamic demand shape. This is basically my view, and flexibility basically is the keyword here.
Yeah, and demand side management. Thank you, Gabor.
Thank you, and welcome to everyone. I think most of the things have already been listed, honestly, but I still have quite a few question marks. Also referring back to the presentation of Michaela and Laszlo regarding the decarbonization, for example, which is proceeding in a direction which Europe and the climate change needs, but still. I just read this morning that based on some analysis, Germany needs at least 18 gigawatt new gas power plants up to 2030 with on the road of closing nuclears and coal power plants. And I think if we think about what will happen up to 2030, there are a lot of things that are currently unsolved, and we do not see how it will happen. Storage can be one solution. Hydrogen can be as well a solution, probably. But I think it's quite sure that wind, solar, and gas itself will probably not solve every problem that we are currently facing. As Michaela also stated, I think integration of the European energy market is definitely the goal we have to achieve, because this is working already. This is working that some countries which have lower production costs can deliver flows to Western European cases, for example, when the Balkan hydropower plants are producing power, but in ways and in time seasonality when they do not, then we can import power in CE region from Western Europe. So I think this is a tool that is working, and we should even extend with additional interconnectors. What I certainly miss at this point, and what we will work on really hard in the exchange as well, is that for PPAs and renewable investment to incentivize these even more, we definitely need, I think, new products and new solutions on the future market trading. Because the hedging and the trading products didn't really change, I think, in the last 10 years. So you always trade base load and peak load. And even you trade these mostly in one location, or you trade spreads, but there is no connected European integrated solution for hedging probably most efficiently the renewable energy. So I think these are the main things that we have to solve somehow. And for example, there's always questions regarding carbon market, what will happen? And I already see questions about this in the question and the answer box. And I think this is a really interesting question. What will happen with the competitiveness of European industry in these prices? As you mentioned in my background, I was working for retail companies who provided energy for industrial customers. And we can see that this price level, for example, day-ahead market in Hungary, again, cleared above 70 euros in the middle of April. This is something that will be really difficult to cope with customers. And I think it's a question how Europe will solve this problem of competitiveness with these high prices. And honestly, I would be really interested to see what László thinks about this, if we can pass the word to each other. Thanks.
László, please go ahead.
Yes, so Europe is not an attractive location for the energy-intensive heavy industry. In fact, the energy-intensive heavy industry has been moving out from Europe for decades, literally decades. This is the same as for many advanced economies. One very important exception is the United States, where in the past decade we have witnessed a relocation. A new energy-intensive industries appeared in the United States, and the industry moved back to the United States because of very low energy prices. But the difference between Europe and the United States is not renewables. The United States is also a very large investor into renewables. The big difference is, of course, shale gas, the incredibly low gas price level in the US, and natural gas is by far the biggest power generation source in the US. So it's difficult to see how Europe would have low energy prices in the context of the energy transition. But I should also say that if you look at the macroeconomic data between, let's say, Germany and the US, during the past decade, then energy prices have been increasing in Germany and declining in the United States. During the same decade, Germany actually ran a large and increasing trade surplus in manufactured goods with the United States. So the German industry's competitiveness is actually improved despite the higher energy costs. Now, of course, the reason for this is that German companies focus on the high value added, high-tech, high-quality parts of the manufacturing value chains. And I think for European industry, this is the only way forward. But I should add also that while Europe was a front runner, a lot of the cost of electricity in Europe is associated with the initial push to make renewables cheap. So Europe spent a lot of money on expensive solar and expensive wind to make wind and solar cheaper, but this has been done. And Europe is no longer alone. So there's a solar revolution unfolding in India, There's a net zero commitment in China from President Xi Jinping himself. So I think the image that Europe is running ahead with the energy transition and other regions are not following, that's not true. This is now a global phenomenon. That I would say a big issue is the regional and social aspects. So the steel industry is not a very high proportion of European GDP, but in a place like Dunajváros in Hungary, a steel plant can be extremely important for employment and social stability in a city, in a region. Also, in Europe, the top 10% of society spend 1/3 of its income share on energy compared to the bottom 10%. So energy prices are 3 times more important for poor people, for their welfare than for rich people, because they spend a much higher proportion of their income on energy. So energy prices can be very, very difficult and very complicated from a social point of view. But from the point of view of industrial competitiveness, I believe the European industry has an ability to cope with them.
Yeah, that's a very good summary. And especially in the region, this is a very sensitive topic. Governments have been toppled over energy prices in the past quite a few times. So thank you for this first round of answers. The biggest question in the room is, of course, how can we ensure that new capacity is being built at a certain cost while power prices remain relatively low for the time being? This debate is now a little bit about to change because power prices have increased in recent years, also given that the EUA price has significantly increased. So the merit order is now shifting and we see higher price levels. Where do you think is a reasonable price level in the years to come to sustain decarbonization at the current, eventually even a higher pace in the next 5 to 10 years? Maybe in the same order again.
Price level.
Leslie.
I think what is important to keep in mind that for conventional power plants, which in the European context, in practice only mean gas turbines, there's very little other investment. So if you operate a gas turbine in the European power system, and especially in the power system that is coming, you are not in the business of generating electricity. You are in the insurance business. Your business is that you keep the lights on when the wind is not blowing and the sun is not shining. And the average utilization of gas turbines in the European system, based on our system modeling, will be slightly more than 1,000 hours a year. Now, you can, in theory, envisage an electricity market design in which, in those hours, electricity prices go through the roof. And then in those hours, gas turbines will make so much money that will generate the investment. But I have to say that you have to be very optimistic about the efficient market hypothesis to trust energy security on that. And we have seen the state of Texas this January, which is governed by the American Republican Party. And it's fair to say that the American Republican Party is more market-friendly and more capitalism-friendly than most European governments. And when the state of Texas had $9,000 per megawatt hour prices during the extreme winter peak, it was very politically controversial. So I think I'm very much in favor of having a safety net, of having a capacity mechanism or a contractual structure which makes sure that the appropriate capacity investments indeed take place. Now, of course, designing a capacity mechanism is a very complex issue, and there are many examples around the world of a badly designed capacity mechanism which created undesirable side effects. So policymakers and regulators have to be careful, but I think in the context of the European energy transition, I think the capacity, we have to make sure that even capacities which have a very unusual production profile and unusual cash flow profile, have a viable investment model.
Thank you. Michaela, next.
Yes, I think I will answer first with a purely quantitative answer and then with a question. So how I see prices, I would say, just to give a quantitative, I would say between 50 and 55 euros as a yearly delivery price. Now my question, and basically like I leave it as an open question to my fellow panelists. How about considering also, just as Germany is already doing, embedded generation for big industrial consumers to cover their domestic or local demand? So I think that, I mean, if that keeps on developing, and if more countries in Europe consider, or more big industrial consumers consider that, that might also shape prices downwards.
Yeah. And another open question mark is, of course, CBAM. So a protective mechanism currently proposed by the Commission, which might or might not help to keep industries within Europe. But that's yet another discussion. Gabor, next. And then we'll actually move to audience questions.
Okay. When you meant Gabor next, you mean the presentation, right?
Sorry, still on this question. Then we'll move to audience questions, and we'll take your presentation last. That's the easiest.
Okay. Well, I think let's just move now to the questions already. I don't have anything that valuable, honestly, to add at this point. Apart from the competitive mechanism, sorry, here I think we had Laszlo also mentioned, we have to make sure that we don't make the same mistake as we did with the feed-in tariffs. So it have to be carefully designed. And apart from this, I really would like to see or hear from Laszlo when he mentions that we need a safety net. What is the source for that? So it's the safety backup solutions and generations. What could be the source? Is it gas or is it something else?
And is there an example of a good capacity mechanism you could highlight? Non-market distortive.
Okay, so that's a very good question. I mean, any capacity mechanism will have a degree of market distortion, because basically when we introduce a capacity mechanism, we basically say that we are concerned that there could be market failures. So a couple of principles that I would suggest. One very important thing is that the capacity mechanism should not be prescriptive for a single technology. So the objective is not to have a new gas turbine or a new hydropower plant or new battery storage. The objective is to have capacity adequacy. So I think the good capacity mechanisms aim to be technologically neutral, aim to create something like a fair competitive environment. I mean, the three most important sources in the European context are going to be demand-side solutions, so demand response aggregation, stationary battery storage, and gas turbines. Now, I believe that with the current state of technology, gas turbines are still necessary. In fact, I also think that even as Europe moves to a net zero energy system, gas turbines will still be necessary, but those gas turbines will be running on pure hydrogen. But I would not advise to have a specific investment policy on gas turbines only. I think regulators should aim to design a system which is competitive, which is transparent, and which also encourages innovation, especially in demand-side solutions.
Okay, thank you. So now moving on to some audience questions and also keeping the time in mind. We'll now spend about 5 minutes on this, and then we'll move to Gabor's final presentation. There've been quite a few questions about nuclear. So to start from the back, Marianne Valentin is asking, how can we be so stupid to switch from nuclear, which is very stable, predictable, to intermittent renewables, which are a real challenge for TSOs. Then, based on your recommendation for nuclear, how do you evaluate market-based full lifetime costs of nuclear, including the storage of nuclear waste, which of course is a big unknown? And I will take all the questions at the same time because we don't have that much time. Do you expect any significant impact on prices after the implementation of NTC-based market coupling between Germany and CE? It switches quite a bit. There's quite some different questions. And the last one is, how high is the perceived risk of power producer bankruptcies? So defaults in the CE area, should carbon prices rise above 50 euros per ton of CO2? So maybe Laszlo, I guess those questions are directly aimed at you if you would like to shoot, and could keep it to about 4 minutes. Thank you.
Yeah. So nuclear is the largest low carbon generating source in Europe. But the European nuclear fleet is aging, and several important European countries, including Germany, have a legally binding no nuclear phase-out policy. Now, it is not impossible to have an energy transition without nuclear, as I believe Germany will achieve that. But our analysis suggests that in countries where there is a social and political acceptance of nuclear, that keeping nuclear in the mix can lead to a more cost-efficient and, from an energy security point of view, easier to manage transition. And a couple of reasons for that. One is the dispatchable baseload production. And this is quite important, especially in the context of the seasonal variations of demand. Also maintaining grid stability. Now, in the European context, any nuclear development is almost certain to be on the site of an existing nuclear project with a brownfield development, which means that you already have a transmission connection, you already have a transformer substation, you don't have to build new infrastructure. And last but not least, a modern nuclear power plant occupies 100 hectares territory and generates as much energy as 2,000 wind turbines. So land use is also a quite important advantage. In our view, the nuclear waste management cost is not the big issue. The big issue is the cost of the initial construction of the nuclear power plant, and also the very large project management risk. Unfortunately, the European nuclear industry has a very bad track record. So the nuclear projects that were launched in Europe in the past decade had a very unfavorable experience from project management and cost evolution. So I don't see a realistic chance of private investment into nuclear. So the countries, including Hungary, which want to stay nuclear, they have to be prepared to have a quite intrusive government policy to make sure that the investment really takes place. I would pass on the market coupling for the other colleagues. On carbon pricing, yes, we definitely think that even after the recent increase of carbon pricing, for a net zero 2050 trajectory, Europe will need higher carbon prices. So in our sustainable development scenario, the modeling suggests that European carbon prices rise further.
Okay, thank you for this very comprehensive response and short response. I think we could have a very long debate on nuclear. I used to work for Areva myself about 10, 11 years ago. It's a very difficult debate, especially in Western Europe. But looking at the time, I would like now to close the panel by giving the floor to Gabor to come up with his presentation. And then we'll move on to the following session right after. So thank you very much to all panelists. It's been a real pleasure to discuss these very complex issues with you. And we look forward to staying in touch. Bye.
Thank you, Christian, for your help. Basically, we just wanted to collect a few ideas and few thoughts about how an integrated European exchange can operate. And in the 10 years of Hungary and HUPX role as a key marketplace and actually a price signal in the whole region of Central Eastern Europe and South and Eastern Europe, we can see, I think, that it's a really important role. And then basically because of the general regional location, Hungary and HUPX is a transit is in the transit zone between Western Europe and Southeastern Europe. And actually, in the recent developments of the increasing Romanian, Bulgarian cross-border capacity, additionally increased these roles and liquidity. And what are the current steps we are doing? In the next slide, you can see that basically, as we discussed all along in this panel, interconnectors, building new ones and extending current ones are actually really important steps. And this is what happened in the 1st of April with the increase of the Hungarian, Slovakian capacity, which has been long debated, and now it's finally active and working, and it actually creates, and hopefully will create even more balanced price in between Western Europe and Southeastern Europe, and in Hungarian prices as well, and the 4MC. You can also see, and we discussed already, the 4MC joining the core region in an NTC-based market coupling mechanisms. So basically, Austria, Germany, and Poland borders will be involved. And as mentioned by Michaela here, the 2 gigawatt interconnector extension between Poland and Germany in the coming years will actually have additional effects. And referring back to the question about the price, I think we can definitely say that less volatility could be expected, I think, between the different parts of Europe. And most probably, and this was already visible in the future markets, the location spreads. For example, in the future market, the spreads Germany to Hungary is already decreased a lot. And I think this is something that could happen in the future. A next important thing on the intraday market could be if Slovakia joins next year the single intraday coupling project. And also next year, we will extend this move towards the integrated market with the flow-based capacity mechanism in the whole core region, now including the 4MC markets. And the Slovenian interconnector goes live next year, start of next year. That's an additional important passageway actually between Southeastern Europe and Western Europe, together with Slovenia and Hungary. A few words about intraday. I think really important tool for managing renewable energy and properly managing and efficiently managing is the intraday market, and even more developed intraday markets. And that's what we are working on with new products like 15 minutes cross-border capacity, which was launched in the end of last year in the Austrian-Hungarian border, and also this year in the Romanian border. This is a clear picture that this creates a liquid and growing market. We have currently 40 members from 14 different countries in Europe. And I think this shows in the next slides as well how the volume picked up, and hopefully with even more improvements on the lead time reduction in the short term, hopefully, this will actually create an environment where renewable energy and the weather risk can be handled in a really nice and stable environment with actually, I think, automatism involved in a really high level. Algo trading is currently something that is part of already most of the European energy markets, but I think this will be simply a must for each trading participants active in the intraday market and in the weather risk affected markets. Here you can see in another slide how the go live on the XBID increased the volumes first in the end of 19. This was actually the hourly product which started, and on the other side, the end of last year, the quarter hourly products. This is given a really big boost for the whole region in terms of intraday trading. This is just a few ideas why IP is really important and I think a must. So simply put, I really honestly think that in the next years, each and every company will have to invest in this unless they really want to lose the competitiveness in this industry. And we also prepared a few slides regarding how an exchange like HUPX can incentivize renewable investments, basically, for example, in the form of guarantees of origin. This could help on the long run to create a more cost-based and transparent investment scenario, basically. And I think we already have quite good examples in Europe, and we will follow this in Hungary and in HUPX as well, starting from next year. And yes, the last 2 slides. Actually, here we just mentioned the Suez Canal blockage with the help of our CHEX gas operation team, because we think it's really important to view it, to put it in light of how much energy was actually transported through here compared to the Hungarian consumption, for example. So 10% of the total Hungarian gas consumption can be measured. And I think it's just a topic that everyone heard a lot, so I don't want to really talk too much about it. But in light of an example, I think it's fair to say that the whole region can be something like a Suez Canal in Europe. So once these interconnectors are working and everyone thinks that they are just there and there is no risk, yes, when they are working, but it's really important that we create an environment and sustain an environment where they are securely working, all the interconnectors and all the exchanges in Europe and in the region, because we could see as well in what happens, for example, when we've seen the decoupling. And I think Laszlo also mentioned that the risk of what we've seen in Texas, we have to make sure that Europe avoids this. And I think that's why Suez is a great analog for this, also in Europe. And last picture is about the Hungarian spot gas prices. I think this is also shows how much interconnected, not just Europe, but the whole world is, since we historically had a lower price level in the MGPs, the Hungarian gas region, than the Western markets. But this has shifted, and we went to a lower spread compared to the Western markets because of most probably because of the gas storage situation that we have in Hungary and also in the region. But the spike you see is, for example, something which the original fundamental reason came from Asia in terms of the LNG shortage. And we are talking about the Hungarian gas exchange. So as we see, not only in Hungary, but the whole world seems to be a lot more connected, and this can bring up also risks which we need to cover. So thanks all for joining us. I think it's really an honor to have so many people coming from so many different locations. Thanks a lot. And that was it on my side. Thanks a lot.
Okay, thank you, Gabor. And apologies to the audience. We actually don't have another panel after this. But thank you very much to everyone who has joined today. We had some 180, 190 participants, which is quite a success. So well done, HUPX. And a big thank you again to all panelists and all those who have contributed, also those in the background who have not been speaking, but have invested quite a bit of time and energy to prepare this very interesting talk. And what we can really take from today is a lot of challenges lie ahead. Many changes are already happening. More are about to come. So this is a very exciting industry and certainly a very interesting decade ahead up to 2030. So thank you again, everyone, and have a great week. Bye.
Thank you. Have a good day.